Hi, this is Atilla Yeşilada reaching out to you from the year 2025. Ho, ho, ho! Merry Christmas and a Happy New Year to all humanity, or whatever you are celebrating. I live in a woke economy and people could get canceled for the slightest choice of expression, so celebrate whatever you want to, okay? Um, As custom dictates, the first video of the year is dedicated to Atilla Yeşilada's infamous forecast for 2025 for the Turkish economy. I'm going to start by giving you my numbers for GDP growth and employment. I'm going to move on to monetary and fiscal policy, which I really don't want to because my grandma taught me if I don't have anything nice to say, I shouldn't say anything at all, but that's just not the case for monetary and fiscal policy. Of course, then inflation will be next, and we're going to look at Turkey's balance of payments. In other words, just how much TL will depreciate versus the dollar. Wait, it's not over. It's not over. If you are patient enough to watch this video to the end, there will be a bonus. Main upside and downside risks. I think in 2025, Turkey might get lucky. Now, before I start to answer the most difficult question of where the heck was I? Well, as I wrote to UN, I have this custom which should be adopted worldwide, which is I consider the period between Thanksgiving and New Year's Eve as a blanket holiday. And I have just drank so much tequila and lime that the Mexican economy overheated in the last month of the year. I wish this was the truth. The fact of the matter is, being a complete airhead, I fell twice and hurt my glute muscles. It was really difficult to even sit. I have been able to maintain my regular work schedule, but really couldn't shoot any videos. Okay, GDP growth and employment. I have screened a large number of forecasts for 2025. The consensus seems to be that Turkey's GDP will grow by 3%. I'm a tad bit more cautious. I'm working with a number like 2.5%, which is way below the average for the last 10 years. Why? Well, one of the main reasons is that over the last few years, the main driver of growth has been household consumption, which has been supported by lavish minimum wage hikes, pension hikes, in other words, transfers from the state to the workers or to retirees. This year, Mr. Erdogan has lowballed the minimum wage hike to 30%. You may say, wow, man, what are you talking about? 30%? Well, since Turkey closed the year with the official CPI of 45%, actually 30% for the whole year means that most blue collar workers would feel they have become poorer. Now, there's another thing. In the country you live, only a tiny portion of the blue collar workers are paid the minimum wage. In Turkey, that's not the case. At least 40% of the workforce is estimated to earn somewhere around the minimum wage, and that's below the poverty level, by the way. Excuse me. The same applies to Turkey's 16.5 million strong retirees, which, according to the official formula, ought to get only 15% for the first 6 months. Now, Mr. Erdogan promised to make an improvement to their pensions, but let's put it this way. Inflation will decelerate in 2025, but real disposable wages, salaries, pensions would lag behind it. That means that the contribution from private consumption to GDP growth will be very minimum. When it comes to fixed income, fixed expenditures, that's outlays by companies for new investment and technology, I am very pessimistic. A couple of years ago, I shot a video claiming Turkey has become a mafia state, which wasn't watched at all, but it's in my archive. You can still see it. But this is the fact, really. It doesn't make sense for Turkish entrepreneurs to start up a new business or to expand their business because either AKP demands that a portion of the profits go to the party or to Mr. Erdogan's cronies, or the MHP party supported mafia comes over and buys your property or assets way below the market value. You think I'm exaggerating and this is anecdotal, but it isn't. It is, in fact, created a new expression for unlawful confiscation, which is mala çökmek, which means coming in and suddenly saying, I'm going to make you an offer you can't refuse. So, really, business appetite for capital outlays is very low. As I shall mention below, fiscal policy will produce non interest deficits and will thus contribute to GDP growth. Finally, in terms of the external account, I think I'm not concerned about Turkey's external deficits, but I don't think that we will be able to generate a massive current account surplus, which would increase GDP. So 2.5% is fine. When it comes to employment, Turkey is a highly labor intensive country, which is also small company heaven. If you invest in Turkish stock market or so, you would know that most of even the largest companies, won't even make it to the Nasdaq in the United States. They are so small. So investing in new technology for these companies don't make sense because they can't scale up and the upfront expenditures are too high. This is why if there is huge demand or increasing demand for their services and products, they increase their payrolls. Last year, we generated over 1 million new places or employment. This year, that's going to decline to 500,000 in my view. First, because, brick and mortar retail is going the way of e-commerce. So one of the most labor-intensive industries, retail or shopping centers, is not going to generate much employment. The same goes through for one of our main export articles, textiles, which is very low value added and suffers under a strong TL. And finally, last year, the artificial appreciation of the Turkish lira in inflation adjusted terms hasn't really hurt tourism too much, simply because 60% of the revenue comes from early reservations made in January and February, while this year, Turkey is really and visibly expensive vis-a-vis, in particular, Greece, because the euro fell against the dollar and other destinations like Egypt and Morocco. Again, I'm not saying tourism will be bad, but it simply won't be able to grow. Coming to monetary and fiscal policy, the Monetary Authority, Central Bank of Turkey, started its monetary easing cycle in December with a 250 basis point cut, so reducing the policy rate from 50% to 47.5%. And I think I'm, in fact, certain that in its January meeting, it will cut by another 250%. When doing so, the central bank started to argue that Turkish economy is producing a lot of slack or output gap. So the conditions on the ground are not inflationary, and that its tight monetary policy and fiscal restraint has reduced domestic demand. None of these arguments is true. As I've explained a few minutes before, Turkey is a country which is going to be under chronic production scarcity simply because the cronyism and the mafia state reduces the appetite to increase supply. Two, of course, the turn of the year wage and pension hikes are low, but still they are above the projected inflation rate for the end of the year, which is 21%. So finally, there is really no trust in this country about the official inflation figures. Several surveys, some conducted by Central Bank of Turkey, suggest that households' inflation expectations 12 months ahead is roughly 18 points higher than the official inflation rate. Even corporates, which are more somber about these issues, expect 48% inflation for year-end 2025, which is more than twice the central bank's target rate. So, a prudent central bank would wait to see very clear signs of disinflation or a domestic demand deficit before acting. But that's not how Turkey works. Everyone knows Mr. Erdogan loves low interest rates. So I think central bank was rushed into this. It's not a lethal error. The big question is when will what would be the final rate for the policy? Given my inflation forecast of 30 to 35%, I think the policy rate ought not to decline below 40%. But even though there is no official consensus, I think the market viewpoint is closer to 35%. Some even claiming that the policy rate will be cut to 30%. So monetary policy too is expansionary, and it might even become a problem for the stability of the Turkish lira in the last quarter of the year. Now, monetary policy could jump in with an easing cycle if it got some help from fiscal restraint, but it isn't. Mr. Mehmet Şimşek, in the main fiscal policy document, Medium Term Economic Program, promised to cut the budget deficit from 5% in 2024, which actually turned out to be true, to 3% this year. Some of the savings will come from lower earthquake expenditures, which are still ongoing, but the rest will come from additional taxes or from stricter enforcement of tax laws. The first is kind of credible, though I'm afraid because of Turkey's high inflationary environment, roughly half the expenditures which lagged from 2024 to 2025 will have to be escalated to the inflation rate, and earthquake-related expenditures will will be higher than the budgetary appropriations. Two, Şimşek intended to pass several tax packages, which were all protested by lobbies and vetoed by Mr. Erdogan. Now he's going around finding small segments of the economy to tax, like e-commerce, which in my view is silly. Economic theory suggests if you have an expanding and new technology, at least for a while you don't tax it too heavily. This is only one example. If you lived in Turkey, you would realize there's a new tax or fee increase every day. For instance, even though my car is registered and I'm considered, a professional who's a taxpayer and registered with the government, I have to register again to have a, smart chip installed so I don't cheat on my gasoline bill, which I can't anyhow, but that chip is going to cost me like $300, which is good revenue for the government. So I think it's reasonable to assume that Turkey's fiscal deficit will be cut to from 5% to 3.5%, maybe. My official forecast is 3.8%, and the non-interest deficit will even go down faster. But nevertheless, if you look at the overall stance of fiscal policy, it's still pouring income into the hands of the households, which is also inflationary. Coming back to inflation, I have modestly good news. As I've said, according to Turkstat, Turkey closed the year with roughly 45% at CPI level. This year, there is some fiscal restraint, as I've explained. The lira is strong, which reduces the contribution of imported goods to inflation. And the turn of the year, wage, salary, and pension hikes are less generous vis-a-vis 2024. Putting all this together, I arrive at an inflation forecast of 30 to 35%. There is a large band. I mean, 30 to 32 is acceptable, but 30 to 35 suggests I have reasonable doubts about the accuracy of my forecast. Yes, I do. If you watch another couple of minutes, I will tell you the upside and downside risks to Turkish economic forecasts, and I think positive surprises would overwhelm negative ones. So that's where the 30% comes in. External deficit, well, there Mr. Mehmet Şimşek achieved a miracle. In 2023, Turkey's current account deficit, the broadest measure of external deficit, was something like 5% of GDP. We only have October data, but there's a consensus that this year the current account deficit will shrink to about 1% of GDP. This is awesome. This is really awesome. Because the biggest problem of Turkey is not only high inflation, but sporadic currency crises or spasms. 1% is very easy to finance, even though Fed and ECB won't be able to cut as once predicted. Still, global financial conditions from the perspective of Turkey would be somewhat easier, in particular if, as I expect, three major credit rating companies increase our credit note or credit rating, I'm sorry, by another notch each. So we can easily finance that. Of course, in 2025, the overvaluation or excessive appreciation of the Turkish lira will weigh on Turkish export, but more importantly, consumer imports would boom. So current account deficit could rise from 1% of GDP to 2% of GDP, which is still sustainable. Turkey's chronic external deficit problem is kicked down the road to 2026. And the most important forecast, probably for most of you, is that with monetary easing having started and fiscal restraint being largely a taboo word for Mr. Erdogan, the only anchor of the current economic reform program, is a strong currency. Turkish lira against the dollar must lose value less than the projected inflation rate. So if this is your inflation path throughout the year, the dollar TL rate should remain below it for two reasons. First, since you can't deal with domestic inflation, at least you want to be able to reduce inflation caused by imported goods and services. Two, you want to drill into the minds of Turkish savers that Turkish lira deposits will yield more than FX deposits to prevent dollarization. In fact, if you can convince them that TL deposits are more profitable or at least provide better protection against inflation vis-a-vis hard currency deposits, a lot of people will get out of the pain trade. That is, will switch their savings from FX to Turkish lira, which will bolster central bank's reserves. And the more ammunition a central bank has, the less pressure there is on the currency. So overall, no crises this year. This is the best I can say. Inflation will still hurt the woman on the street, but probably there would be somewhat of a less grumbling. Upside and downside surprises, main downside surprise. And probably the subject of my next video is early elections or a constitutional referendum. As you know, before any kind of ballot, 3 to 4 months before any kind of ballot, the fiscal spigot, fiscal floodgates are opened. Everybody gets new raises, pork barreling galore, and of course, inflation and growth move upwards. I think this is a very realistic risk. I would assign a 60% probability that Turkey will see some kind of balloting before the end of the year, or the talk of balloting and pork barreling prior to balloting in the first half of 2026 would start in the final quarter of the year. Major upside, the friendship between Erdogan and Trump, which could increase investor sentiment, and emerging markets funds could switch their positions from less favorable countries like China, Mexico, I don't know, Brazil, to Turkey. In fact, one of my most watched videos below was Turkish lira will be the king of emerging markets, a hypothesis I still support today. Another upside risk or positive surprise, a decline in energy prices. Energy is our leading import item. Why do I think energy prices might decrease? Well, there's an oversupply, and I'm not really convinced that the efforts by the Chinese government is to stop deflation and low economic growth. Currently, when I shot this video, Brent was roughly $75 per barrel. Give me Brent at $50, and I would believe that Turkish inflation would fall to 20% at the end of the year. Thank you very much. Hope to see you soon, barring injuries and other acts of God, to talk more about Turkey. Once again, Happy New Year to you all, and this is Atilla Yeşilada saying goodbye.